Hey everyone, let's jump right into this explainer and unpack a seemingly simple rule change that will literally drag an estimated $3 trillion of hidden debt right onto corporate balance sheets globally. If you deal with financial statements in any capacity, you already know that the IFRS 16 accounting standard fundamentally changed how businesses report their leases. It was an absolute earthquake for the balance sheet, and that is exactly what we're going to decode today.
But before we actually get to the rules themselves, we have to ask the multi-million-dollar question that prompted this massive accounting overhaul in the first place. For decades, investors and regulators, they were looking at financial reports and asking how much debt is actually hiding off the balance sheet. So we've got a really clear roadmap for this explainer. We're going to cover the hidden debt problem, define what counts as a lease, go through the five-step accounting process, look at a practical case study, check out the financial impact, and finally wrap up with some common mistakes you definitely want to avoid. All right, let's kick things off with Section 1, the hidden debt problem, specifically looking at the era before 2019. So before 2019, companies could classify a ton of their contracts as operating leases, which basically kept them completely off the balance sheet. It created this really dangerous illusion that companies were much less leveraged than they actually were. I mean, it was a massive blind spot. But then, from January 2019 onwards, IFRS 16 steps in and acts like a massive spotlight. Almost all leases must now be recognized directly on the balance sheet. It brought this wave of massive financial transparency to stakeholders everywhere. Which brings us to Section 2, defining a lease. Basically, what actually goes on that balance sheet now? Now, what's genuinely fascinating here is how specific the standard gets about what actually qualifies as a lease. It's not just, paying for a service. For a lease to exist under IFRS 16, two specific things have to happen. First, you need an identified asset, meaning a specific building, a specific machine, or a specific vehicle. And second, the customer has to have the right to direct its use and obtain substantially all economic benefits from it. Basically, if you completely control exactly how and when that specific asset is used, boom, you have a lease. But hey, you do get a slight breather here. You don't have to capitalize absolutely everything. The standard does include some practical exemptions, so you can skip all this complex accounting for short-term leases, meaning anything that's 12 months or less, assuming there's no purchase option at the end. You also get a pass for low-value items. Think laptops, printers, small office furniture, that kind of stuff. For those, you can just expense the payments directly as they happen, the old-fashioned way. Okay, moving on to Section 3, the five-step accounting process, which is basically the ultimate lessee playbook. This framework gives us a perfect systematic checklist. Step 1, isolate your exact lease payments, which includes fixed and certain variable ones. Step 2, determine your exact lease term and make sure you include any extensions you're reasonably certain you'll actually use. Step 3 is applying a discount rate, typically your incremental borrowing rate. Step 4, you calculate your lease liability based on those discounted future payments. And finally, Step 5, calculate your brand new right of use or ROU asset. Let's see this in action. Section 4, IFRS 16 in practice, using our ABC Limited case study.
So imagine our fictional company, ABC Ltd, is leasing an office for 5 years. They're paying $100,000 annually at the end of each year, and their discount rate is 6%. Now, basic math tells us 5 times $100,000 is $500,000, right? But since those payments happen over 5 years into the future, we have to calculate their present value. Because as we know, money today is worth more than money tomorrow. When we do that math, the actual starting liability recognized isn't $500,000. It's exactly $421,240. If you look at how this breaks down, notice how that 6% discount rate actually shrinks the present value of each future $100,000 payment. In year 1, your payment is worth about $94,000 today. Fast forward to year 5, and that same $100,000 payment is worth less than $75,000 in today's dollars because of the discount factor. Summing up those present values across all 5 years is what gives us our total liability of $421,240. So, on day 1, your initial journal entry is just beautifully balanced. You're going to debit your right-of-use asset for $421,240, officially recognizing the asset you now control. And on the flip side, you credit your lease liability for that exact same amount, $421,240, recognizing your corresponding financial obligation. Now, as year 1 progresses, things get a bit more interesting because we apply the ladder technique for subsequent measurement. It's no longer just writing off a simple run check. We start with our liability of $421,240.
First, we calculate our 6% interest expense on that balance, which comes out to $25,274. Then, when you hand over your actual $100,000 cash payment to the landlord, we subtract that interest to find your principal reduction, which is $74,726. This drops your closing liability to $346,514. And completely separately from all of that, we have to depreciate the ROU asset over the 5-year term. So we take the original $421,240 divided by 5, and we get a flat $84,248 in depreciation expense for the year. All right, let's look at the bigger picture in Section 5, Financial Impact and Disclosures. Basically, where do these numbers actually live? This is really where the standard totally changes the game. On your statement of financial position or your balance sheet, you are no longer just booking a flat rent expense in the background somewhere. Instead, your balance sheet bloats up with new ROU assets in the non-current section and new debts in the form of lease liabilities. Meanwhile, over on the statement of profit or loss, that traditional single-line item for rent expense, it is completely gone. It shifts entirely to show two separate expenses: depreciation of the asset and interest on the liability. And what is absolutely fascinating here is the sheer contrast between the two parties involved. You have two parties signing the exact same contract, but facing entirely different accounting realities. While the lessee, the one actually renting the asset, faces massive administrative changes to recognize all these new assets and liabilities, the lessor's accounting rules remain largely untouched. The landlord simply continues to classify leases as finance or operating. For them, it's basically business as usual. Okay, we are in the home stretch. Section 6, Common Mistakes to Avoid, our quick IFRS 16 checklist. You might actually want to take a screenshot of this checklist because ignoring embedded leases in service contracts is a guaranteed way to mess up your balance sheet. You absolutely must look closely to see if a service secretly includes a specific controlled asset. Other major pitfalls: using an incorrect lease term by forgetting about extension options you're actually likely to take, guessing an unreasonable discount rate, or misclassifying variable payments. Remember, you only include variable payments in your liability if they are linked to an index or a rate, not if they're purely based on usage or sales. And finally, failing to reassess your math when a lease is modified, like adding extra office space. Doing that will just throw your entire ledger completely out of balance. Ultimately, IFRS 16 forced the corporate world to answer one really tough question honestly. Do your financial statements truly reflect your actual economic commitments? By bringing all these contracts right onto the balance sheet, stakeholders finally get a complete, transparent picture. So as you review your own leases and implement this framework, ask yourself, what other financial obligations might still be hiding in the shadows?